Hi, I'm Patu from freefincal. In this video, I want to talk about when one should start booking profit for a 10-year goal. And by this, I mean when you should start reducing your equity exposure for a 10-year goal. I just used booking profit because that captures more attention. So I had asked a question, a poll in Facebook group Asan Ideas for Wealth, and I had asked for a 15-year goal. When would you start reducing equity allocation? And the majority of votes went for they will start reducing equity allocation after 10 years. So for 10 years, they will invest at 60% equity. That's the allocation I had suggested. At 10 years, they'll invest at 60% equity and they'll stop and they'll start reducing equity exposure. The problem here is, and this is applicable for the 10-year goal also, the problem here is for the 15-year goal, what happens in the 10th year if there is a huge market crash? Just before you said, I'm going to start reducing equity exposure, what happens if there's a huge market crash? Or what happens if there's a huge market crash, 50% drop or 40% drop in the index in the ninth year or so? Or for a 10-year goal, what happens if there is a big crash in the fifth year or sixth year or seventh year? So this is one of the most important problems in portfolio management, and I have already studied this and incorporated this in my robo advisory portal, a form of this in my robo advisory portal, where I tell you that no matter what the goal is, once you start with an equity allocation, reduce it in a stepwise fashion. After just a few years, if you start with 60% equity for a 15-year goal, just reduce it after to for 50% or so after a few years, maybe even 5, 3, 4, 5 or so, and then after a couple of years, reduce it stepwise, and so on. And if you do this, you will be able to handle any kind of market crash or any kind of sequence of returns or bad returns or good return sequences and achieve your target corpus. So the focus is not on the asset allocation or the return expectation, but on the target corpus. So I will link I will link that study here. I've given the video also. I'll link both of it here, the article and the video, for that. And I will also redo that study more rigorously for several years. What happens if you do it without that stepwise allocation and so on, and talk about it. But I want to show you some results for a particular case, for example, a 10-year goal. Before I do that, I want to quickly point out that the Momentum Low Volatility Stock Screener for October 2019 is published. You can download it from this link. There's been a big change in the number of stocks that meet this criterion from last month to this month because of the change in the market dynamics and so on. So, all right. So what you're seeing here is about 180 data points or so. I don't remember the exact number, but about 180. Each data point is a 5-year SIP return. That is, you do an SIP for 5 years in Nifty 50 Total Returns Index and dividends included. And that SIP returns, all possible returns over 5 years, is shown here. So returns can be anywhere between 50% and below 10%. It can be 1%, 2% as well, and so on. This is all the way up to a last business date in October 2019. Now the point is that notice you can see the market, the movement of the market. People keep saying SIP will reduce risk. No matter what happens to the market, if you do SIP, you will average returns, blah, blah, blah. All that is sales bullshit. Notice you can see the market movements right there. You can actually see the Nifty move in that SIP return. Each of it is a 5-year window which is moving forward in time. So my question is, for a 10-year goal, what happens if you expect? See, I can bet my net worth that if you go and ask the average advisor out there, they will say for a 10-year goal you can have 60 to 70% of equity. This is the advice that most advisors will give you, and this is complete nonsense. They will not stop with that nonsense. They will say in the last 2-3 years you can reduce equity exposure. That is enough. In fact, many people voted for last 3 years before deadline in the poll I just mentioned. So what happens after 5 years? You find out that an SIP in Nifty 50 has given you less than a fixed deposit return. You don't assume it will not happen to you. And it's so annoying whenever I show rolling returns graph. People will say, but then active funds will beat Nifty. No, active funds will also behave like that. There'll probably be a little bit higher return. For example, this is HDFC equity. It has also behaved the same way, and that's Nifty. That's Nifty 500 total returns index. There are 222 data points here. That has also behaved like similar to the Nifty 500 or Nifty 50, and that has also given returns less than what you expect. Comparable to an FD, much less than that, comparable to an SB account, whatever. If that's the situation after 5 years, what will you do? Will you bet that there will be a turnaround? Or what happens if there's a further crash? So this is the big problem in goal-based investing that you must tackle, and the way to tackle is to get rid of return expectations, have a target corpus, and have a proper equity reduction schedule or profit booking schedule, and invest the right amount for that. So this is for 7 years, and there are people who say for a 10-year goal it is enough if you book profits after the 7th year. What happens if these are about 150 or so data points? I don't remember, maybe a little bit less. 7-year rolling return SIPs. Every data point is a 7-year SIP return. Notice here also you get comfortably less than 10% returns comparable to FD returns. Even less than FD returns are possible. What happens if this is the situation for your SIP investment after 7 years for a 10-year goal? So please don't assume an SIP will work. You have to manage risk, but for managing risk, you don't have to look at market timing. You don't have to do market timing. You don't have to look at market news. Look at your own personal goal, personal need, and target corpus. I have linked one example here. I will post more videos of such examples. This is the biggest DIY investing challenge or advisors challenge. Many advisors do not follow this. They give you all sort of nonsense. Their return expectation straight away will be wrong. So they don't have this kind of a strategy. I think they should educate themselves better. I mean, otherwise, one crash, even crash need not happen. 3 years, 4 years of very low returns can kill your goal. So you have to be very careful about this and plan your goal accordingly from day one. From day one, you should invest the right amount so that you can take into account the reduction, the stepwise reduction in equity allocation, or very crudely profit booking. So that's what I wanted to say in this video. I'll catch you again later.